Thanks again for attending our webinar here today. Today, our topic is really how to help your business owner clients save taxes and grow their wealth. In particular, we're going to be discussing split dollar strategies and how those work. And again, Jordan Pence at Visors Resource Company, and hope everybody is doing well. So anyways, I'll go ahead and get started, and we'll go from there. So our agenda for today is we're going to talk about who's a fit, C Corp taxation under the Tax Cuts and Jobs Act of 2017, split dollar structure, the tax implications. We're going to do a case study, get some illustrations and whatnot. And what if your client doesn't have a C Corp? How do we get around that, or how do we solve those problems for us? If you have any questions while I'm going, feel free to stop me. This is a little bit of a complicated strategy, and there's a lot of moving parts, but I really think it is one of the best things that a business owner can do to benefit themselves tax-wise and growing their wealth. So who is a fit? Number one, you want to look at an annual income of at least 500,000 is what I would say. You're going to want to look at people who are under 60. I mean, 60 is really kind of the limit for where insurance starts to not work as well. I mean, there's cases where over 60-year-olds can work, or it can work for over 60-year-olds. However, if somebody does not have a C Corp, they have an S Corp or an LLC or whatever, if they are making at least 500,000, then I think this strategy, we can justify doing this strategy or making the planning necessary to do this strategy because of the tax savings. That's really the tax savings aspect of it. Now, if anybody owns a C corporation, they're doing business through a C corporation, which I'm going to cover what a C corporation is. But if anybody already has a C corporation, then split dollar makes sense for them just straight up. I mean, no matter what their income level is, they should really be considering this type of plan. I suppose maybe if they're not really making much money, but then why would you consider insurance to begin with, or a permanent insurance plan? So, really in any income level, if they are a C Corp already, because they likely have retained earnings that we can utilize. So I keep talking about what C Corps and what a C Corp is. Well, this is sort of the structure of a C corporation. A C corporation pays its own taxes, has its own tax return. Another key feature of a C corporation is that it has a flat tax of 21%. So it pays its own taxes and it has a flat tax. So in my example there, if a company has $1 million of profits, maybe, and what I mean by $1 million of profits, I'm including the owner's wages. So maybe the owner is paid out $150,000 on a W-2. That's $36,000 in taxes. However, the rest of the income from the C corporation is only taxed at 21%. So the difference, $850,000, is only taxed at 21%. So what that means is you're paying significantly less in taxes through a C corporation. Now, of course, everybody, probably not everybody knows this, but many people will say this. Now that you've got it in the C corporation, it's sort of stuck in the C corporation. So that's a negative with the C corporations. And that's why you don't see them as prevalent or prominently, because of what many accountants will say, double tax and things like that. But just from a high level, this is how a C Corp's tax and how it works. So that's really where the split dollar functionality comes into play. So what can you do with that money that was taxed at 21%? And what options do you have? And so that's really, like I said, where where this split dollar arrangement can come into play. So how does it work? This is a lot of text. I will give a brief overview. Then the next slide is, a sort of graphic representation. But in a split dollar arrangement, the premiums are paid by the corporation, the company. So you're utilizing dollars that were taxed at 21% versus my income tax rate. So if I'm in a 37% tax bracket, I'm paying approximately $16,000 less per 100,000 on the premium dollars that I'm putting in. So in order for those premiums to not be considered income to me as the business owner, we're treating them as loans. And so the person doing this split dollar is assigning part of the policy back to the company as collateral. So the company is entitled to reimbursement for its cost basis in the policy from policy values or death proceeds. Later on, like in any typical overfunded life insurance policy, we can access those values with no tax consequences, and we can utilize them for future income purposes. So this, I think, is a better way to look at it. So again, if you take a step back, I have the company over here, and you can't see where I'm pointing because I'm pointing out to my screen, but you have the company, and the tax rate that my company is paying is 21%. So I'm taking after-tax dollars from 21%, and I'm putting that into the insurance policy via premium payments. If I'm doing this for myself, I, as the business owner individually, is the owner of that policy. And in order to not make, those premium payments considered income, I'm giving my company back effectively ownership interest in this policy equivalent to what it put in. So there's a collateral assignment against the policy equivalent to what, and I said I put in, what the company put in is what I meant to say. And so the government's deemed this arrangement as a what they call below market loan. So there's an economic benefit to having a below market loan. And if essentially you have to just recognize the economic benefit of that as income personally. So I have to recognize the fact that I'm getting a 0 interest rate loan and I have to pay the tax on that. So more on that a little bit later. So keep that in mind. There's a little bit of tax involved with this, but the bottom line is my company owns the cost basis. I own everything else in the policy. So I get the growth in the policy tax-free. Later on, this policy is going to grow substantially. It's going to have 4, 5, 600,000 of gains in it. That's all on my side of the ledger, tax-free. And that's why you do this. You save taxes now, you grow tax-free, and the seed money, so to speak, I paid basically half the tax than I would have ordinarily paid. Pretty good deal. So I mentioned AFR rates. So this is the only little amount of tax that I have to pay. So when there's a sort of closely related parties that are borrowing against each other, there's been some rules put in place, and that's where the AFR rates come into play. And so the applicable federal rate is basically a minimum interest rate. And so because we're not charging any interest on this, it's like I'm receiving income equivalent to what the AFR rate is, the minimum interest rate. And so this is something that's widely published, pretty easy to find. We will use the blended rate for demand loans, which just simply makes this easier to calculate. And it is written directly into the split dollar agreement. So it's pretty easy to calculate and keep track of. And so this bullet point here, because we're charging 0% interest on the premiums that are put into the policy, we have to recognize that as income, which is what this is basically saying. So anyways, back to the point, AFR rates have been extremely low last year. For last year, the interest rate was 13 basis points. Before that, 89 basis points. Before that, 2.4. There were only really a few years where the interest really spiked, and pretty much throughout history, it's been well below 3% AFR rate. So in other words, if I was doing 100,000 in this split dollar arrangement, and it's the year 2022, which I guess it actually is, obviously, but in the year 2022, I'd have to recognize 1.4% of income, which is basically like recognizing $1,000 and $1,400 of income. Now I just have to pay tax on that, which is going to be somewhere between $400 and $500 of actual tax that I have to pay out. So the bottom line of this is the amount of economic benefit tax that you're having to endure is extremely small compared to the tax savings that you got by utilizing the C Corp and the growth that you're going to get tax-free through the policy. So before I get into the case study, I just wanted to take a quick step back, all the way back to why you consider using life insurance in this type of arrangement. And the biggest benefit of it is the tax deferred growth of values, not to mention the unlimited contribution, the no 10% penalty for early access, no R&Ds, income tax-free death benefit, and so on and so forth. So it's really a great way to accumulate cash values and grow cash values without significant tax consequences. So the next thing that we need to really look at is, how would you put together a proposal for this? And so this is really a little bit of an overview of our proposal that we put together. We want to talk a little bit about the split dollar plan, which I've gone over this a little bit, basic benefits to life insurance. But we also want to think about, when talking with a business owner, how do they plan for retirement? Many business owners are considering selling their business. Is it really worth as much as you think it's worth? How do you plan on selling it? Do you even have a qualified buyer? Are you actually going to get top dollar? So really some things to think about. In addition to that, many business owners have a lot of money tied up in 401k plans, simple plans, SEP plans, things like that. And really, we want to highlight the maybe mistake of accumulating too much into qualified plans. So these next few slides really just deal with that and are included in our presentation as additional talking points. So this is a bit of a side note as compared to the rest of the presentation, but really, why does the government like qualified plans? And that's because you get a small tax savings on the front end, and really you just delayed the problem. You made the problem bigger in the future. So you can see the 70,000 savings on the upfront and the 326,000 on the back end, the tax cost on the back end. And finally, how high have taxes been in the past? Right now, we're in a pretty low tax environment. Do you think taxes will be higher in the future? Most people say yes. That's the point of this. So back to the split dollar, back to the proposal. Here's an example with some real numbers. I'm assuming a 2.5% AFR rate in this particular proposal, but the company in this case is putting in $50,000. So you've got that $50,000 premium going in. Again, we'd have the collateral assignment of $50,000 going back to the company. Me, as the participant or the owner of the policy, has to recognize a $1,250 income tax. It's income that I'm recognizing. It's a economic benefit. And then I'll pay tax if I'm in the 37% tax bracket of $463 on that. However, on the $50,000 that I'm putting into that I'm retaining in the C Corp and then I'm putting into the policy, you got to remember I'm saving right there approximately 8,500 if I'm in the highest bracket. So significant tax savings on the front end, small while you're doing this, small tax consequences while we're doing this, but big results on the back end with the tax-free income. So the assumptions that I have here are just simply 37% tax bracket, 6% gross rate, pre-tax contribution of 63,000. That's just 50,000 grossed up by 21%. So this is a slide that I personally really like. And I think it can break down the overall strategy here really well. So what this is on the left-hand side, I have the business values, the company values. On the right-hand side, I have the personal values of the business owner. And you can see this is where the split and the split dollar name comes from, because the business is owning its cost basis. And you can see if you go down to, let's just say year 10, the company's put in $500,000. The cash value is 500,000 that it has collaterally assigned to it, and the death benefit is 500,000 that it has collaterally assigned to it. Me, on the other hand, I have the economic benefit tax. Again, this is assuming 2.5%, and I have the tax for that, which is the next column. And then right here, you can see under cash value, the amount that I own is the 57,290. So not only have I saved the 8,500 of ordinary income tax every year on the 50,000, but I've also grown this tax free by, let's just call it 60,000. That continues on. You can see the cash value growth. I stopped premiums in year 11. You don't have to do that. You could do really whatever you want, but this is just assuming you stop in year 11. And the cash values obviously grow from there. So this is really the accumulation phase of this type of strategy. And it's really provides a lot of flexibility. I'll stop here and discuss that right now, because if my business needed some money, it could access the collateral assignment that it has against it, meaning I could take a loan from the policy, give it back to the company. That would actually reduce the amount of economic benefit that I'm having to recognize. So there's some significant flexibility that is really built into this. Now I'd like to really address this year 15. So in theory, you could keep this sort of split dollar arrangement going for maybe eternity. You could just keep it going. You keep paying the economic benefit tax. However, what I'm showing in here, this isn't probably really how you would actually do it. You might do it a myriad of different ways, but I'm showing it where you're rolling out of the deal or rolling out of the split dollar plan all in 1 year. So in effect, what I'm doing is sending $500,000 from the policy back to the corporation. So now the corporation has 500,000 of cash. The corporation is then taking then writing a dividend check to me, and I'm paying the tax. So the dividend check would be 500,000. I pay the tax of 100,000 or 20%. And then I put the remaining 400,000 back into the policy. So in reality, you'd probably space that out over a couple of years, or you might look at, what your income is going to be in the future and pay it out in a different manner. This is probably the least aggressive way to roll out of a split dollar plan. So just keeping that in mind is kind of the maybe worst case isn't the right name, but it's possibly the maybe least aggressive way to do it. We'll put it that way. So anyways, so After that rollout takes place, you own the policy free and clear. There's no, collateral assignment back to your company. There's no holdback from the company. Nothing. You have it. You have it outright. And from there, all I'm doing is just showing after tax income as compared to a qualified plan. So on the left hand side, I have the split dollar. On the right hand side, I have the qualified plan. And as you can see, starting at age 66, this was a 50-year-old, but starting at age 66, I have an income of 53,823. This 100,000 is the net of that transaction that I mentioned. And then in the qualified plan, I can only get out about 34,000. And so these just simply go out till age 100. So remember this, going all the way back to here, what I'm doing is taking money that was taxed at 21%. So if I'm in a 37% tax bracket, I'm paying half the tax now. I'm putting it into the split dollar plan. I'm paying a little bit of tax and economic benefit, but it's small. So I'm paying a little bit of tax on the economic benefit, and I'm growing that money tax deferred. I can access it tax free. And then I'm paying the rest of the tax later or when I choose. And so one thing to remember, and I've had this discussion with many people, is you have to remember 21% in tax plus 20% of dividend tax isn't 41%. You're paying the 20% on the after-tax amount of the profits from the corporation. So that is actually only about 35 to 36% in total tax that you pay on this transaction. So in effect, you're paying the same in total tax, but you're deferring or spreading out the second half of it for as long as you'd like. So that's one thing to remember. And how you can do the math is if I have $100 in pre-tax and I earn that through a C corporation, 21% of 100 goes down to 79. 20% of 79 is 15.8. So then you subtract that and you end up with it's just over 35%. So that's how that works in there. So anyways, that's just another point to bring up. So then in our typical presentation that we'll do, we'll compare again the split dollar on the green to the qualified plan at current tax rates and then a higher tax rate. And then what would you have to earn to match the insurance in your qualified plan? And that's you have to earn 8.18%. So just some ways to compare things. So moving on from there, the last point, if anybody has any questions, feel free to bring that up. But the last point here, or the biggest thing that you want to consider is, or the biggest question that I get when I typically do this is, well, my client doesn't have a C corporation or they aren't a C corporation. And this is why in the beginning I brought up, if they already are a C corporation, great, we can do this right now. In fact, they should be doing this because this is a great way to get retained earnings out of their company and grow it for themselves personally, like I said. However, if you do not have a C corporation, you're probably an S corp or an LLC. So in that type of scenario, here's sort of the going all the way back to the beginning of the presentation. If I have $1 million of profit, I'm probably paying some, and this is okay, maybe 40.8 is a little aggressive because I'm adding on there the Obamacare tax, but whatever, even if it's 37%, it doesn't really matter. But if I have that arrangement, everything flows through to my personal tax return. And I'm in theory paying top tax on most of my earnings. Well, another way to do it is if I can set up a C corporation on the side to maybe provide management functions, HR functions, marketing, marketing services, things like that. I can set up the C corporation and bring over those expenses to the management company inside a C corporation. And of course, that C corporation is going to earn a level of profits. And in this case, I'm showing moving over basically 200,000 of profits into a MSO, which is a C corporation. And then you pay taxes on that 200,000. So in effect, in this little arrangement that I'm showing here, he moves over 200,000 off of $1 million, and we're saving approximately 40,000 in taxes. And then once you get inside that MSO, that's when you do the split dollar. So what do you do once it gets, quote, stuck inside the C corporation? Well, that's where we set up the split dollar arrangement. So that's one of the ways that somebody who isn't a C corporation currently, we can go ahead and take care of that for them and come up with a way to, leverage their taxes and reduce their taxes, really. So that's really the end of my presentation. If you have any questions, feel free to reach out to us via email. You can call me. The number here at our office is 972-338-9655. You can try me or Brendan. We'd be happy to answer any questions. We'd love to help you on any of cases like this. We provide the case design, so we'll put together these illustrations and the presentations. Many companies this does work for. Like I said in the beginning, I would highly recommend somebody making at least 500,000. That way you can justify the expense of setting up the C corporation, the movement from the C corporation to the S corp, and setting that stuff up. Somebody asked for the number again. It's 972-338-9655. And I'll go ahead and type that in here. Send. So our we provide all the documentation and things like that for the implementation, and we can help with implementation as well. So just reach out. Feel free to run your scenario by us to see if it can work for this type of strategy. Again, this is one of the best, I think, ways to help a business owner not only save taxes, but also save for their retirement or otherwise. This doesn't have to necessarily be for retirement. I know that's what we talk about a lot, but it's just a way to put aside money in a tax advantage manner so they aren't excessively taxed.